Hey y'all, this is JT here. Today I'm going to show you how my back tester works. We're going to be testing a 30 wide put butterfly. So I'm going to show you how that structure looks. We're not going to break down the mechanics of the trade. I'm assuming if you're here, you are advanced enough you don't need to know that. And just a forewarning, if you do feel like you need that, this is probably way over your head and you need to take some time and go back and do some learning before you get to this point. Disclaimer, this is not financial advice. This is all historical data. I'm not telling you to trade this. I'm not telling you this is going to be profitable. I'm just showing you what it's done in the past. Any decisions you make forward are your own. So, I like the put butterfly. I've always felt that in the market, puts are bought as a surplus or hedging, and therefore they're fairly easy to make money on. Whereas, I feel like you've got more calls done as people trying to make money, so you've got a little competition there. It's just my opinion. I have no empirical evidence to back that up. So in this case, we're doing a 0 DTE put butterfly. You are going easiest way, and I normally don't trade. This is just a really easy way. And actually, I take that back. I do trade on the web a lot using Thinkorswim. I just like that platform. It's very simple, and I'm doing a simple trade. Um, the desktop app to me is a little kludgy. So, and this is really easy to show you what we're doing as well. So you just throw an iron condor in there, convert it to a put, and then the way this is set up, you've got an equal number of contracts in your outer legs, and then your center, you're going to have twice as many. And you're selling the center, you're buying the outer legs. So this particular one that we have back tested is going to be 30 wide. I mean, it's pretty simple. You put the middle one at the money. Let's see. So we need to go, that's about right, 42.95. So you're just going 30 above and 30 below. So 95, that's going to be 65, and then that's going to be 25. So if you've done this right, it should look equal. In this app, if it's you're not seeing the outer edges, you can go and deselect it and reselect it, and then it gives you a prettier picture. So the risk here are actually your cost is going to be for 10 contracts, which is typically what I'm always trading and what I'm back testing against as well, is going to be right at 14,000. And then it's almost equal. You can make almost the exact same amount. When you start in the morning, there's a little more skew, but this is your basic structure. In the morning, it's very flat, so it's not terribly sensitive to going out of range here. But what you're going to find as the day goes on and you get some decay, it's going to get steep fairly quick. So if you find yourself out here, time is not your friend. Once you start getting to around 10:30 or 11:30, if I see the trade not improving, I will typically exit, even if I'm not at my criteria. That's just past experience when I was doing this. So here's what it looks like. Here's your profile. So now let's go in and look at the back testing on this trade and see what the results look like for the past year. So the back tester basically loops through all these iterations that I want to test. For this current one, we're testing the max stop and max exit I've ever seen are around $20 over time. And we're only going to go back to February to test things. But it also has a capability. I can test multiple widths during the same session, or I can actually do offsets, which is instead of starting the center at the money, you can move it in the money or out of the money, and run it through all these iterations of testing. So you can literally do thousands, of tests at once and look at them all on a spreadsheet, as we're going to see, and be able to compare where they're at. The back end of this is, and the reason I don't use some of the online back testers, I found that they weren't granular enough for day trading. I tried at first doing 10-second intervals and found them to be horribly inaccurate for actual results. Um, Later, I increased it to 5 second, and then finally settled in on 3 second was the fastest, the minimum that I could find um, to get it really good and accurate. You do still get occasional bullshit stop outs, and that's the only way to call them. You can. There's been a couple of times Thinkorswim has stopped this trade out because it does jump around a bit. And you'll find I don't do any really granular testing at really low amounts, like a stop at say zero point 0.5 or $1, because it just jumps around too much. You would hit it too fast and too easy. So this typically works better if you're doing like a 3 versus 4 stop versus exit type trade, or even larger. Different like condors, typically way more stable. You can get those more granular, but this particular one is not, especially when you start trading it. And that's one fallacy of backtesting. You can backtest it and find that, oh, it wins and does great, and then you go start day trading it and you start getting all these crap stops that you see. Um, and then, I actually, in my case, I continued to trade it even after that. I wrote my own trading bot that kind of does um, a floating type. You have to have a threshold, kind of like an audio compressor. You have to be above that threshold for like 12 seconds because you typically are not having it shoot up so violently that you're going to lose a whole crap ton of money. It just doesn't move that fast in this particular trade. So typically, I found in mine, I do a 12-second delay. If it exceeds the threshold, 12 seconds, you get out. And do you lose more money that way? Yes, you can. I mean, you'll be a good bit past your stops if you did get a really violent move. But when you add how many bullshit losses you've had, that you've lost 4,000 a day. So say you've done three, BS stop outs in a month, you're up to 12,000. Well, you're not going to lose 12,000 on that slide um, doing it using your trading bot. I don't know if there's online trading bots that'll do the same. Mine just does it, manually coded. So, but you can see it's running. It takes a while. The database, just for your information, it's I've got 2 years data in it. It takes about a terabyte every 6 months, so its optimization is very hefty. And also in the program, because a lot of these queries are pretty intensive when you're pulling in. There's what I think 6 million entries per day. So once the program gets running, I do a lot of caching. So if you're writing your own program, you better be ready to do that. Cache all your trade times. So if you're doing multiple iterations and you're pulling all the trades for that day and you've got them in cache, and it uses a lot of memory, but if you've got them cached, it just zips through them and you can do it. Otherwise, you'll be there for weeks and weeks, getting all these trades, and you'll just wear out your disks on your server. I find it's way more efficient. My first resolve was to try to bump up the memory in my SQL Server, to where it could do a lot of the caching. But when you're talking about that mass quantity of data, it's just not effective when you do it, in your program, because you're only getting zero DTE and only for a specific set of days, and only for a specific 30 wide items. It goes a lot faster. So because you're only doing different stops. You're getting the exact same trade, exact same quotes, for every day. So once you've got them all cached, you can see now it's running way faster, now that it's got a day under its belt. Sorry, a full iteration. So I'm going to fast forward now to when we're done, and let's take a look and see what I produced. The backtester is finished. So now we want to look at the results. The way this program works, it prints out a spreadsheet for each iteration that it runs, and you also get a summary. Um, so in the summary, I print out the width, the stop, the exit. Um, Now, to give a little background, the way this program works, it starts at 25,000 as your account value. So it also, some other assumptions, it doesn't look at buying power to make sure you have enough to do it. It's just assuming blindly. And the reason I do that is I don't want, I do want to see if I have a really bad run on one and it goes super, super negative. That has the potential to be where these right here are buying, maybe selling works better. So that's just an easy way to find one of those. So you have to take that with a grain of salt. Some of these may not be realistic. They could have went way in the hole based on drawdown, and you would have run out of money. So part of that you do have to look at. Now there is a drawdown column. There's the amount of wins and losses in trades. And now these columns over here, the losses are how many streaks you had. So there were 26 one-loss streaks, 13 two-loss streaks, and so on. And if there's a 999 and this lost 9, that means there was a streak longer than 9 long. Now the reason these are new, this is something I've been kind of working on. I've been to do a lower stress version of this rather than trading every day. I've been looking for what I call home run trades. So if you find a trade, and I don't think we're going to see any in here. Well, this one may be. So you notice there's no trades that are losses past 3. And so what you can do is you can go look at this particular trade setup, and chances are you could say, hey, there's only been 3 losses after a 2-loss losing streak. So if you're in a 2-loss losing streak, you could go do the trade the next day and you have a very high probability of it winning. So to me, that's worth looking at. And if you're in a 3-loss streak, they haven't ever had in the past year a 4 losing streak. So, I mean, you can bet the farm on that one. Now, I'm not saying I would go, put my whole account YOLO'd on it or anything. I'm just saying that's what I'm looking for now, as I want very, very, very high probability of success trade days. That tends to be way more less stressful than just the way some of these others work, and I'll get into that more. So the other thing I look at when I'm checking into these is the wins versus losses. You get some that can be successful, like down, let's say, which granted, this run right here I'm about to show you is during a market change. So none of these are successful now. I can guarantee that. Everything changed after August 1st. There isn't anything real definitive. I'm not going to bother going into that or researching it. I'll show it to you. But my assumption is I think something happened in the Japanese market that really unsettled everything. And I feel like big money pulled out of the market. And that's when all of a sudden the VIX didn't change, but you started seeing a lot of volatility intraday, and I feel like that's when you look, there's less volume. I just think the institutions maybe moved over into something safer at the moment. So that's just my hunch. I don't have any research, and I've certainly tried to find an indicator that shows me that, but I haven't found anything yet. So um, anyway, back on what I was looking at, you could find this one that ended up being, made 113,000. But you can look at the wins and losses and see that you lose twice as much as you win. And there are cases like that. And I don't like trading those because you end up, loss after loss after loss. And then it's going to be, this is a 10 exit, 4 stop. So you're losing 4,000 constantly. But every once in a while, you get a $10,000 win. And it's just enough to make you money. And those I find very disheartening to trade. I prefer to keep mine with a much higher win-loss ratio and a much smaller drawdown, because that can be very, very disheartening too. If you find a big, long, long drawdown and you don't know when to get out, because what I'm going to show you as well, I am not looking for the holy grail thing that works all the time, because I can tell you they don't exist. And if they do, they don't make a lot. Your chances are you'd be better off just investing your money in SPX, taking your 8% or whatever it's on average of now, and walk away happy. So this is how you, what I'm looking at here is what the current now market is doing. It may change tomorrow, or like I said before, it changed on 8/1. And I felt like it changed, but I kept in this trade for probably another week and lost, a good $10,000 before I finally said, okay, it's time to stop trading this and wait and see. So, okay, and I could go analyze some of these, but I'm going to go to the cheat sheet. Oh, and it looks like this right here because I forgot to run exit 2, which is the one I used. So I reran it. It'll just append to the file here. So I'm going to go back and find exit 2 stop 4. So this trade right here is the trade I did for the past, I don't remember when I started, but it was right about when the market started really kind of just going sideways. And I had analyzed this and it did really well. So it writes these out as CSV files. I don't write them to Excel because directly and try to do any of this markup I'm doing because it's very time consuming. And a lot of times I change the way I want to mark things up. So it would be something I'd have to go programmatically change. So first thing I like to do is see my losses visually. Now you can go in here and change like all these EMA, MACD, and all these indicators I've added, by the way, are all calculated in the database. Another big proponent or thing I like to encourage, if you don't know how to calculate any of those columns right there, or the Greeks for that matter, you need to stop trading and go and learn how to do that. Get a spreadsheet, get the formula, write it, and learn how. It is so beneficial to know how all these Greeks are calculated, why they're there, what they mean. And then also, if you are blindly trading on MACD and you don't know what MACD is, you're doing yourself a big injustice. You'd be a much smarter trader to go and learn what these indicators are showing you and how they're calculated. It makes you much smarter. So anyway, back off of that. Just to show you what some of these are, because I'm going to have questions. That's your EMA 1226. Your MACD differential is how much it changed per day. So while your MACD may be smoothly going up and down, you may have days where the actual MACD, like this day where it violently moved. It was very fast. And then sometimes you'll find patterns like the next day was a loss. So you may find, hey, when the MACD, shows a day that there was a big change, you're going to have a loss next day. And you can identify patterns like that. I'm not saying that's the pattern here, but in some of these trades, you can find stuff like that very consistent. This column up here is when the MACD actually changed from positive to negative, from day to day. So instead of going up, it started going down. Then you have RS, relative strength. That's RSI, which is indexed. Differential, that's how much the RSI changed. Either the RS or RSI. I guess it's the RSI changed day to day. Then I just have your opens, closes, and other information. This EMC and EMP was expected move. It requires another calculation and pull out of the database, so I don't always print those just in time's sake. So if you take a look at this over time and just look at the balance, you can go in here and graph it and see. So this is what I was trading for quite a while. This trade had been steadily going up. It kind of flatlined there for a little while, but I stayed in it and it kept going, kept going. This is going to be your right after August, when things started changing big time. And then it's not profitable, even to now. So actually, if you almost did this trade backwards, and started selling it, which isn't always true. And I can show that when you run it, things are a lot different. Um, you're going to find that you can't just flat out reverse a trade and all of a sudden make money. Some trades you can. This particular one, it doesn't work that way. This one is a lot different selling it. I just have to go in it and show you. So we're not going to focus on that today, but we're going to just show you what we were trading. So if you were trading this trade, with 10 contracts, you're either making 2,000 or losing 4. This trade very rarely ever had a 3-day loss, so this is another one that would have been good, and even now would still be pretty good for a home run one, except for we're on a streak. And I have not uploaded into the database. I have 2 separate servers that capture. One captures all of the data and writes it to flat files from the so it can be really, really fast and not held up in case the database was having issues or I was running a back test. And then I have a separate app that I'm actually making some changes to make it more efficient that uploads the data to the database. So we're only doing to 1018 right now. You do have your options here listed. Get up here to the top. So I have my option keys, and I'm going to show you what I'm going to drop that into as well in just a minute. That's why these are in here. So one other reason I didn't like any of the back testers online is a lot of times I would be suspect on days that it had trades, and there's really no easy way to research and see why on that day other than going in thinkorswim and manually looking, which was difficult. So I introduced an error into this run, which I'm going to show you now. So say this day where it lost, if you look, this is the start time. This is the time it stopped out. So it actually stopped out before the buy time. And that's because I took the check out of there to check, hey, beforehand, because I knew you were going to get some days that look like this. So if I wanted to go research, and I'd highly recommend this in any back testing, you need a visual way to look at it. So if I want to go look at this day and see why I lost, and the other thing it does help you do is figure out why you lost, and maybe there's a smarter way. But so this is another part of my suite. It's a website that's hosted locally that it graphs the actual value of whatever stock structure, option structure I built. And I can do multiple in different colors and see how they perform next to each other. And you can actually, there's a multiplier field up here because say you're trying a 30 wide versus a 10 wide versus a whatever width you want to go with, they're all a different value. So in order to get them overlaid on each other to see which ones are twitchier or more volatile, you can do a multiplier to get their monetary value the same in the start. So you can see this one out of the gate, it was a big move, crazy move day. So you can see the option values went really berserk in the very beginning. And that's what triggered that stop out. Otherwise, this was a winner. So, and I'm going to zoom out. You can actually take the interval that I'm using and have it not as granular. So it can, because these charts are limited in how much they can zoom in and zoom out and fit on a screen, because this literally is a lot of ticks on the screen. It's every single one. So if you take it out to about every third one, it makes it much more visible. And these are trading view charts, trading view light. It's free to use, very easy to implement. And this is SPX in white. So you can see this day, it actually started at around $19 and it lost value, which is what you want it to do when you bought it. You want it to, be worth more. So, and you can tell because it's negative. You paid for it. You paid 19 for it, and now I'm going to turn around and sell it for 23. So that's why it's negative, because that's truly what it is when you buy. It's negative. You paid money for it. So one thing you'll notice in here, this is quite a big move, and like I showed earlier, This particular option structure is not volatile in the morning at all. It's very stable and very forgiving, which is why I like trading it. And it's also, since the value doesn't change much, that's the other real pretty thing about it. You can jump in it late. Like this day, with it shooting down like this, I would have said hell no. And I would have just sat it out and waited. And then, once I saw it stabilize, I may have considered entering it at that point. But you can see it only gained what, $1. So you'd have, only lost $1,000 not jumping in it in the first hour. So, and it's pretty linear on its decay, unless the market, of course, is going crazy and that's, you're getting your value from the market. So, and like I said before, this particular option structure does get extremely sensitive towards the end of the day. So I rarely ever let this one run out to the end. So anyhow, this gives you a visual representation. The other thing I can do is go up here and tell it what timestamp I want to see all my options and what expiration, and hit update, and I can get my printout up here as well. So this is a real cool tool to compare. Some other little things, there's the total price of all options starting for the day was 75. The skew, and I'll get to that in a second, was 121, which I'll show you in a minute. And then there's a current skew and current price, which, because this thing can run during a current day and graph real time, which is super, super useful. So, and this updated to give you all my options up here. So, the other thing I have is a skew chart, and I'm not going to go into how these are calculated, but at any given day, usually more puts are sold because they're hedges, like I was saying. And typically, even more so when the market is going to end up, when I think the assumption is the market is going up that day. And this is, of course, all my speculation, but I've noticed a correlation when the market is going to go up, or they think it is. Doesn't always work, but when they think the market is going to go up, you will see a lot more put volume. And this is, I call this demand. It's not volume, it's not price, it's a formula I've done that I found accurate, and I'm not going to divulge how I do it yet, anyway, maybe later. But I found it very accurate to reflect how puts are being sold that day versus calls. And typically, when you see more skew down here, and this is actually a representation of the difference between the calls right here. So there's a 91 point skew, and that's not price again, that's just a formula I use. And typically at the end of the day, it's not as accurate. It's better in the beginning of the day. But if I notice a huge skew, typically, if these are perfectly even, it's normally a very level or typically a very wonky day. You get a lot of ups and downs, but it doesn't typically trend. If I see this skew here, it's usually going to be or let me take that back. If I see a slight skew here, it's typically an even day or gently up day. If I see a huge skew here, like up in the 100s, 200s in the morning time, it's going to be a trend up day. If these are even number of calls and puts, it's usually a trend down day. And so that's what I use this for. I'll look at it right out of the gate. And if I see a skew on my chart that's big, this one was kind of big at 121, but if you look, it actually lay down relatively fast. So it's normally way up here higher. That was probably just a quick anomalous read that wasn't caught because it was such a crazy morning that right there. Um, so that's how I do it. These are the tools I use, when I trade and when I'm doing back testing, and typically how I do a back test. And so again, this was a good, looking at this, I would have looked, hey, I would have won today, so something's wrong with my back tester. So then I go and look, and I would have found, oh, geez, I wasn't, for some reason I turned off filtering because the program itself was running through and doing a full day's quotes, not after the start time at 8:31. So this is it. This was my back tester that I use in my trading and in my research. This is my first YouTube video. Hope you enjoyed it. And if you would like to see more breaking down different structures, I would be happy to test out a structure. Some future videos as well. This is just the tip of the iceberg. I can take and look at, um, an option like, let's say, I'll go show some examples. So I could do one where I did a trailing stop or even an intelligent one, maybe a trailing stop of 2000 after it's 2000, below so that you're guaranteed money, or a break even that kicks in at a certain level so that you don't lose money. You can build all kinds of intelligence. Most of it's already built into it, and do all kinds of testing. And I have really found that you can just about take any um, not all, but just about any structure, option structure, or strategy, and find a way to make it profitable. It may not be the most profitable, but you can certainly find a way to make it profitable in most cases. Fair winds and following seas. Hope to see y'all again soon.